Let's look at an example of preparing financial statements. Here are the 7 steps. First, start with the trial balance. Make sure total debits equal total credits. Step 2. Prepare and record journal entries for transactions not yet been entered for that reporting period. Third, prepare and adjust a trial balance after recording those journal entries and make sure total debits equals total credits. Fourth, prepare the income statement that shows revenues less expenses equals profits. Fifth, close temporary accounts. Revenue, expenses, dividends, and drawings. They are the temporary accounts. Close them by transferring their individual balances to a newly created profit and loss summary account. Sixth, close the balance in the profit and loss summary account and transfer the difference between debit and credits in that account to retained profit account under owner's equity category, shareholders equity category. 7, prepare the balance sheet. Step 1. Get the trial balance at the reporting date. Make sure total debits equal total credits. 550 debits equal 550 credits. Step 2. Examine the transactions not yet entered and prepare journal entries and record them. There are 3 transactions here. Prepaid insurance expired during the year is $50. Supplies on hand should be $50. Depreciation expense for the plant is $100. Prepaid insurance. Prepaid insurance is an asset. It decreases because that asset is being used up. Becomes an expense. So debit insurance expense and credit prepaid insurance. Supplies. On hand should be 50. It's an asset. Supplies is 100. It should be 50. Asset should reduce. So we decrease the asset supplies. And that asset is being used up. during the year as supplies expense. Debit supplies expense and credit supplies 50. Depreciation expense is $100. Debit expense, depreciation expense increases, and provision for accumulated depreciation increase. Credit, accumulated depreciation. Journal entries have been recorded. Once they are recorded, they are included in the adjustment column. If this is a spreadsheet, we have the initial trial balance, debit and credit. The next two columns will have the adjustments, debits and credits. And the last two columns are the final trial balance. Prepare an adjusted trial balance. When preparing the adjusted trial balance, please make sure that when you add the initial trial balance and the adjustments, that the like and the like will increase, the like and the unlike will decrease. For example, here's prepaid insurance, which is a debit. Adjustment is a credit. So debit 200, credit 50, the final trial balance is 150. Supplies, debit 100, adjustment is credit 50, final trial balance is 50. Once the final trial balance is prepared, make sure that total debits equals total credits. Now, we need to do step 4 and step 5. Step 4 is to prepare the income statement, and step 5 is to close the temporary accounts. The temporary accounts are revenue, expenses, withdrawals, and income summary or the profit and loss summary. All other accounts are permanent accounts. For example, the balance sheet, assets, liabilities, and owner's capital are permanent accounts. In other words, we can also say that all other accounts are temporary accounts. They must be, the balances in them must be closed before we start the next year, next reporting year. So that we have the final trial balance, step 4 is to prepare the income statement. Here we prepare the income statement. We take the income accounts and the expenses accounts. Income accounts are credit, expense accounts are debit, and income less expenses equal the profit. Step 5 is to close temporary accounts. Temporary accounts are income and expenses, dividends, drawings, and also the profit and loss summary. So first, let's close the income accounts and the expenses account. When we say close, what we mean is that we make the balances in them 0. So income is a credit. Now we enter a debit. So debit and credit are equal. the balance is 0. Then there are expenses which are debits. We enter equal amounts of credits so that the balances in the expense accounts become 0. The difference between the two to balance this journal entry, the debits should equal credit. To make that happen, we need additional debit of 90. That is the profit and loss summary. We now need to close the profit and loss summary, which is also a temporary account. It has a debit. To close it, or to make the account balance 0 in that, we credit 90. When we credit 90, we need to debit somewhere. We debit shareholders' capital retained profit account 90. So what we did is effectively we transferred the loss in the income statement onto the balance sheet to retain profits. We did it by closing the income statement account and creating a profit and loss summary account, and then closing the profit and loss summary account and transferring that to retained profit. It went through a couple of steps. Because revenue and expenses are part of shareholders' capital, part of equity. So we close those accounts because they are part of equity. Now the total under debit and total under credit should be equal. So in this instance, it is 500 and 500, and now we can prepare the balance sheet because the income statement accounts are now closed. Income, expenses, and profit and loss summary accounts are now closed. There's nothing needed. All the account balances here are accounts on the balance sheet, and we can prepare the balance sheet. Here's the balance sheet. That is our step 7.